Welcome everyone. I'm excited to have you here today. Today, we're diving into unlocking institutional trading strategies for serious traders. The focus will be on order blocks within the smart money concept, or SMC. We'll explore what these are, how they work, and how you can apply them to elevate your trading game. So, let's get started and see how these strategies can make a real difference in your trading journey. Let's start by looking at the focus of smart money concepts, or SMC. It centers around three key areas: price behavior, liquidity, and market structure. Understanding how these elements interact is crucial. Price behavior refers to how the market moves and reacts over time, often influenced by the actions of those with the most capital. Liquidity is about the availability of buy and sell orders that allow the market to move smoothly, which is often targeted by smart money to create or capitalize on price movements. Market structure involves the overall landscape of price levels, trends, and support or resistance zones. Smart money tends to operate within this structure, using it to guide their strategic moves. Now, moving to how price is created, smart money is responsible for creating the initial moves, setting the tone for the market. Retail traders tend to follow these movements, often reacting to the signals and trends established by institutional players. This naturally leads us to market direction. Large capital controls the overall direction of the market. These big players, banks, hedge funds, market makers, have the power to dictate whether prices go up or down. Their actions influence the market's rhythm and trend. Speaking of institutional players, they are the core of smart money. Banks, hedge funds, and market makers are the entities that have the capital and expertise to move markets. Their strategies and trades often drive the market's structure and trend. So, in essence, smart money concept is about understanding how these powerful players operate behind the scenes, how they influence price behavior, create liquidity, and steer the overall market direction. Recognizing this helps us align our trading strategies with the true drivers of market movement. Now, let's talk about these high liquidity zones where institutional orders are placed. These zones are what we call order blocks. Essentially, they are strategic areas in the market where institutions tend to put their large orders because there's a lot of liquidity there. This means they can execute their trades with minimal impact on the price. When we say define order blocks, we're referring to these specific zones that serve as key points for institutional activity. Orders are not placed randomly. They are strategically positioned where maximum liquidity exists. This helps institutions absorb their large positions without causing significant price disruption. The idea is to seek liquidity. Institutions want to find areas where they can execute large trades without moving the market against themselves. To do this effectively, they break down their large orders into smaller blocks. This process helps them manage the impact their trades might have on the price. Splitting positions into smaller chunks allows institutions to enter or exit their positions gradually. They can't simply dump massive trades at market price without risking moving the market unfavorably. Large capital entry, therefore, requires careful planning and strategic placement of orders within these order blocks. So, the main reason institutions use order blocks is to facilitate the efficient entry and exit of large positions. By understanding where these blocks are, we can better anticipate market movements and spot potential areas of institutional interest. Order blocks are essentially the footprints left by smart money activity in the market. They tell us where the big players are placing their orders. The key idea here is that price often revisits these zones, almost like a retracing to fill in remaining orders before it continues in the original direction. This is crucial because it shows us where the institutional orders are waiting to be executed. When we talk about price return, we're referring to these zones of latent institutional orders that are just waiting to be fulfilled. These are the unfilled orders that the big players leave behind, often before a significant move. The last candle before a major price move, whether bullish or bearish, is especially important because it often marks the formation of an order block. So, Understanding what an order block is helps us see where the big money is operating and where the market might turn or continue. It's a vital concept for anticipating potential reversals or breakouts, tying directly into our overall theme of reading market footprints to stay ahead. All right, let's dive into slide 5. Here, we're talking about two key types of order blocks that can signal potential market moves. First up, we have the bearish order block. This is essentially a supply zone. It forms right after the last bullish candle before a strong bearish price impulse. When you see this, it suggests that a significant supply area has been established, and it could lead to a potential sell setup. On the flip side, we have the bullish order block. This acts as a demand zone. It appears after the last bearish candle before a powerful bullish price move. Recognizing this helps us identify where buyers are stepping in strongly, indicating a potential buy setup. Understanding these order blocks is crucial because they help us anticipate future price reactions. They serve as key reference points for where the market could turn, allowing us to make more informed trading decisions. So, whether you're looking for potential entries or exits, spotting these zones can give you a significant edge in your trading strategy. All right, let's dive into the importance of market structure when identifying valid order blocks. First off, if there's no clear market structure, then we can't really consider an order block to be valid. Market structure gives us the context and the framework to see where the institutional activity is likely happening. Now, it's common for smart money to sweep liquidity, which basically means they target stops or liquidity pools before they initiate their main move. This liquidity sweep often happens just before a big price shift, so spotting these areas can be key to understanding potential future moves. When we see liquidity being taken before a move, the subsequent price action should be supported by significant trading activity. That means high volume or momentum should be visible, confirming that a strong force is behind the move. This is crucial because a valid order block must precede a powerful, conviction-driven price move. It's not just about a candle or a small bounce. It's about a move that shows clear intent from institutional players. Usually, after these order blocks, we see a strong impulsive move, a clear shift in market direction, or the continuation of a trend. This signals that the institutions are actively driving the market. Another key point is that the market often shows a break of structure, or BOS, which confirms that a significant change has occurred. This break helps validate that the order block was indeed a meaningful point of interest. Remember, the validity of an order block isn't just about any candle on the chart. It's about the structure behind it. A valid order block is supported by the overall market context, the liquidity, and the subsequent strong moves. So, in summary, always look for a structured environment, signs of liquidity being swept, high volume, and impulsive moves to confirm that an order block is truly significant and worth paying attention to. Let's dive into the concept of zone touch. This is about how we identify key areas on the chart where price reacts, signaling potential market activity. When we talk about market structure and liquidity, we're looking at how the overall flow of the market and the available liquidity can influence these zones. Confirmation is crucial here. It's about waiting for that extra signal or reaction to validate that a zone is significant. We also consider historical price reaction zones, which are areas in the past where price has shown strong responses, making them likely to do so again. Unfilled institutional orders are another key point. These are orders from big players that haven't been executed yet, and they often act as magnets for price. Now, the logic behind all this is that by understanding where these zones are and how they interact with market structure and liquidity, we can better anticipate moves. The medium and high accuracy levels indicate how precise our zone identification can be. More precise zones help in making better trading decisions. When it comes to the types of zones, retail-based price zones are more about how individual traders see and react to these areas, whereas institutional or smart money zones are driven by the actions of larger players with more influence over the market. The core concept here is supply and demand, which underpins how we identify these zones. These are areas where buying or selling pressure is concentrated. An order block is a specific type of zone that often marks the origin of a move. Think of it as a footprint of institutional activity. It's important to understand the difference between order blocks and traditional supply and demand zones. Order blocks are more precise and are often associated with institutional activity, while traditional zones can be broader and less specific. Recognizing these differences helps us align our strategies with the true market drivers. By mastering these concepts, we can better anticipate market moves and improve our trading accuracy. Remember, the goal is to combine these insights to develop a more disciplined and informed approach to trading. All right, now that we've identified our trend direction, the next crucial step is to patiently wait for the price to retrace back into our previously identified order block zone. This is where the market offers us a potential entry point, so patience here is key. Once the price returns to that zone, we need to focus on extending the zone itself. For a bullish order block, draw the extension from the open of the candle to its low. Conversely, for a bearish order block, extend from the open to the high of that candle. This helps us define the precise area where the price might reverse. Next, we locate the last opposing candle before the break of structure, or BOS. For example, if we're looking at a bullish OB, find the last bearish candle before the market broke higher. If it's a bearish OB, identify the last bullish candle before the structure breaks lower. This opposing candle provides critical confirmation of the market's previous move. Then, we pinpoint where the market structure was clearly broken by an impulsive move, which is our BOS. Recognizing this break is essential as it signals a shift in the market trend and helps us validate our order block. After that, we mark the break of structure on our charts. Confirm whether the bias is still bullish or bearish on higher timeframes, as this broader context strengthens our decision-making process. Finally, always remember to wait patiently for the price to return into your order block zone before considering an entry. This retracement is where the market often offers a high probability setup, aligning with the overall trend and structure we've analyzed. Patience and discipline here are what make this strategy effective. All right, when it comes to entering a trade based on an order block, never just jump in blindly on the first touch. It's crucial to wait for confirmation. By confirming a break of structure, or BOS, on a smaller timeframe, you gain a much tighter and more reliable entry point. So, what do we look for on that lower timeframe? One key sign is a strong rejection of the order block zone, which indicates that price is not willing to go higher or lower and could reverse. This could be a rejection candle or an engulfing pattern that signals a reversal is happening. Another important concept is liquidity sweep. Sometimes, price will briefly move past a previous high or low to grab liquidity. Think of it as a quick grab for orders before revering. It's a sign that the market may be about to change direction. We also pay attention to a break in internal structure on the lower timeframe after price enters the order block. This is known as a market structure shift, or MSS, and it indicates that the current trend might be revering or pausing. In summary, the key is to look for these confirming signals, rejection patterns, liquidity sweeps, and structure shifts before entering. This ensures that your entry is backed by strong evidence rather than just a hunch, and it aligns with the overall theme of trading with precision and confidence. All right, let's wrap things up with some key points on risk management and trade placement. First, it's important to aim for a minimum risk-reward ratio of at least 1 to 2, or even 1 to 3 if possible. This means your potential reward should significantly outweigh your risk, helping to ensure your overall profitability. Next, when we're looking at targets for liquidity grabs, we focus on equal highs and lows. These are areas where the market has previously tested and reversed, making them ideal zones for liquidity to be accumulated or released. Recognizing these zones helps us anticipate market moves more accurately. We also pay close attention to significant liquidity zones. These are the areas where large orders tend to cluster, causing noticeable price reactions. Identifying previous swing highs and lows is crucial because they serve as reference points for setting our targets and stop-loss levels. Speaking of which, for take-profit placement in a bearish order block, you want to set your target just above the order block. Conversely, for bullish order blocks, your target should be just below. This ensures you're capturing the move at a logical reversal point without getting prematurely stopped out. When it comes to stop-loss, placement is just as critical. Place it beyond the order block to give your trade room to breathe, but still within a logical level that protects you if the market moves against you. Remember, properly placing your stop-loss and take profit helps manage risk and maximize potential gains. Overall, understanding where to take profits and how to place your stop-loss in relation to order blocks and liquidity zones is fundamental to a disciplined trading approach. It ties everything together: risk management, target setting, and market structure, so you can trade confidently and consistently.